Hi there, and welcome to episode 61 of B2B SaaS Marketing Snacks. I'm Brian Graff, I'm the CEO of Kalungi, and I'm here again with Kalungi's co-founder, Stein Hendricks, who's a serial SaaS marketing executive and ex-Microsoft product marketing leader. Today, we talk through what factors you should look for in a company to indicate if it has a high potential for marketing growth. Say you're an investor doing diligence on a company, or even an executive or an employee that's looking at your own company to gauge how fast it can grow. You'll want to know if you're looking at a rocket or a tugboat in terms of speed and growth. Looking at the areas we discuss in this episode will give you that certainty, will allow you to quickly determine how much potential a company has from a marketing perspective, and will let you know if you should invest your time and capital into the company or if you should search somewhere else. Let's get into it.
Okay, Stein, thank you again for joining. Today, we have a good topic. I think this one is something that a lot of either early stage founders and or executives are asking, but also we're almost zooming out a little bit into the world of investment and basically taking a look at a company from the outside and understanding if there is a good potential for growth, right? If whether you're a new executive coming into a company or an investor looking to buy a company or even just want to take a step back and look at where you are, it's really important to see if your company has a strong potential for growth, and then how and if you can invest in that growth going forward. So again, we come into an area where you have a lot of experience and you've seen a lot of different variations of this, but really wanted to kind of open the question to you of what do you look for in a company when you're trying to understand how viable it is going forward? What are its chances to really expand in the market, right, and take hold or nail a niche? Maybe let's just start there and see where the conversation goes.
Yeah, we often call this diligence, right, or an audit. An audit when it's more in the specific marketing context or go-to-market context, and then we encounter this both when companies say, "Hey, how can we grow? How can we find the right partners to grow?" Whether it's an agency or a new executive coming in, usually people want to know what the state of affairs is, right? So that's an audit. And then in my work, I'm also usually involved in diligence on investments, right? Whether it's more of a private equity late stage investment or something that's much earlier. You usually want to kind of know what you got, right? And then dig a little into kind of the go-to-market. So for that, there is a really nice kind of journey that we look forward. Is a company have they reached MVP stage? Have they really reached product market fit? Have they reached product market fit in one market or in multiple markets? And then have they shown an ability to scale? And I think, Brian, we could kind of dive into, based on the journey, on kind of three parts of the audit. One is kind of what's the state of the market that you're in, right? Is there room to grow and all those type of questions? And then the second is kind of what type of go-to-market does the market warrant, right? If you sell things that cost $100 per month, you have a different go-to-market kind of options versus when you sell something that you can charge thousands of dollars per month for. And then the last factor would be, how do you then actually turn that go-to-market motion, that strategy, into the actual ARR growth, right? Which is a combination usually of retaining your clients, monetizing them, and getting more clients. And I think, diving into those three lenses might be good. And then also maybe the last, and we'll go deeper again a little later in the conversation, but when I do diligence, you usually also want to validate a growth thesis. Like if an investor comes in and they say, "Hey, we think this company has potential to do more," it's often a function of a new strategic direction, right? Maybe an expansion into a new market, doubling down on an existing market. So that would be the question. There is the strategy that we think will support that new go-to-market, that expanded go-to-market, that pivot in some situation. Is that viable, right? Do we understand what that strategy looks like? And let's go into detail a little more later. And then the second question would be, can we actually afford to go down that go-to-market strategy? And that goes back to the question that's also often in the audit, right? Is the go-to-market motion compatible with the market that you're in? So full circle. Does that sound good to go through it like that, Brian?
Yeah, that sounds great. And I think just to your point, right, to take it from the investment perspective, there's so much of this that would never show up on a balance sheet, right, or on a P&L, that's so critical to look at, right? Because as an investor, right, or even again zooming out to if you're an executive, looking at revenue growth, right, or even MQL numbers as they raise or lower is not going to give you the level of detail that you need to really know the potential of the company that you're working with, right? So asking the questions around those categories that you just mentioned, I think is really critical. It gives you a much better indication of do we have a shot at this? Can we really scale this thing, or is this have we already kind of reached our potential from a marketing perspective? So let's start with the market. When you're looking at a company, when you're doing diligence, say, and you're looking at a company, what are some of the indicators that you look at from a market perspective to show potential?
So first you look at, is the market itself at a certain stage of maturity, right? If you think of the amount of players in that category, you first look, is there even a category that's named, right? Are there some of the analysts could start with the more strategic analysts like Gartner, etc. But then you have, and some of these companies are owned by Gartner. Then you have the different kind of review websites, right? Capterra, Software Advice. There's many of them. G2 Crowd. Is there any kind of indication that this category is at a certain level of maturity? Because the amount of players that are in the category, that the category has a name, that there are a certain level of reviews of this category, right? And where you already see maybe some players are the clear leaders and others are kind of just trying to disrupt the category. So getting a sense of the market maturity, sort of looking outside in a little bit first. How many of the competitors that you see in that category are you actually encountering, right? That's kind of a confirmation if you actually understand what category you're in. And then if you encounter them, do you win, do you lose? What does that tell you? But kind of just I call this situational awareness a little bit, right? Where are you in that external market?
And with that, right, that does quite a few things, right? But that would tell you or us, right, what go-to-market strategy they should be using, right? If it's a competitive market, maybe that's a niche down and carve out situation where you need to find a gap in the market, right, and start to exploit it. So seeing if that is something that the company's doing is critical, or if it's, say, on the other end of the spectrum, right, an immature market, then it's all about, I would be looking at, is the company really establishing a market for itself, right? Is it creating a category? Is it educating its audience? Does it have an audience on its capabilities, and why, basically pulling them out of stasis, why they need to change? Those would be the areas
Absolutely.
that I think about. What do you think about like market size? How do you look at if a company even is targeting the right size of market to support its business goals?
Well, it goes a little bit to your earlier point. If you have decided that in a mature or an existing category, your strategy is going to be to differentiate yourself, to nail a niche, so to speak, to go after a smaller part of the market that has unique needs that you are uniquely positioned to cater to, to solve for, then your question on how big is the market or how big should it be, becomes really about how do you define that niche. Right? If the category has a certain size, maybe it's large, and we usually call that the TAM, right? The total addressable market. It's really important to understand what the SAM really is, right? What part of the market can you actually service? And this really means, literally, can you actually service? As in, do you have the right language support? Do you have the right ability to onboard customers? Do you have the packaging and the pricing aligned with how those customers in that part of the market buy, right? So what part of the market can you service? And then what's less here, maybe relevant, that maybe we talk about that a little bit in the go-to-market motion section, but what part of the market do you want to service? Which is going from SAM, the serviceable addressable market, to the SOM, the serviceable and also obtainable part of the market. And obtainable really is often a matter of choices that you make, right? You have limited resources, not only limited time, but you have only so many people on the team, you have so many dollars to run ads or to build content, right? And all those things will restrict you in how much, even if your serviceable addressable market is very big, how much of that market you can actually really focus on, right? So what part of the market can you obtain? But again, let's park that for now, because that's more of when you have your go-to-market decisions to make, right? Are you really clear or where you spend those scarce resources. But back to your question, how big? So what is the serviceable part of the market? Not the TAM, but really what's the SAM? The only way to actually, I think, define that in a way that's useful for a software company is to actually write down the ICP, the ideal customer profile. That is often a very good definition of the serviceable, addressable part of the market, the SAM. Write down a very specific ICP. And of course, the only way to know for sure that you can actually service that market if you also have a lot of clients that fit that ICP profile, right? So do you actually have a real beachhead that you've established? So that's how I would start, Brian, and then answering your question with actual numbers becomes more of a math exercise, right? If you know that this is the type of ICP, these are the filters, right? They have to be in this type of industry, they have to have this size, they have to be in this part of the world, right? Then it's a question of can you get the right data, or can you source, or even manually, gather the right data to answer the question, how many potential suspects or prospects are out there?
It's a fantastic point. Whenever I've entered a company and been doing diligence, trying to set up marketing, that's one of the first questions that I ask is, have you established an ideal customer profile? And if the answer is no, then that's usually where we need to start, because that informs all of a lot of what we'll talk about in the future of this episode, but everything that we've talked about today, right? How big is the market? How mature is it? What go-to-market strategy do you start using?
Yeah, I think the word ideal is ideal is kind of the difference between SAM and SOM, honestly. SAM could be your customer profile, just describing a lot of the customers that you have been able to service, right? So that's your serviceable part of the market. And then when you go from SAM to SOM, where you say, hey, what part of the market can I realistically obtain given limited time, limited resource, then the word ideal will really help you, right? It sort of tells you, okay, if I can service all these clients, which ones do I want to service if I can only service a smaller number?
Absolutely. What do you think about, this is kind of market-based, but kind of not, right? Half and half. What do you think about product differentiation when you're looking at a company?
The assessment of your ideal customer profile is, of course, based on where have you had success. So if you believe that customers who pay you and stay, who also maybe are telling others about you, who pay, stay, and say so to others, you can argue that that's a great litmus test for is your positioning good enough, right? Are you unique, special enough for those customers to be a good fit? I would start there. Product differentiation, of course, is a little bit in the eye of the beholder. Every customer will have their own favorite feature or their own favorite reason why they do business with you. Some of them has nothing to do with the product. It could be about the experience or someone they know with your company or reputation you have, maybe working with others. So there could be all kinds of reasons why you win. But if the product is a big part of that, and your capabilities, the features that you have, maybe your adherence to certain policies or ability to do something in a certain language, then you would find that out by creating that ICP, because in the ICP it would say, hey, these are the requirements for a customer to be ideal, because they usually fit what you uniquely offer.
Yeah, very true. And also, just I think if you can match those two things together, right, it creates your niche, right? That is your niche. And if you can do that well, then that sets you up for a lot of success in the long term. I've been in a few companies where I've seen the competition. I started to do competitive research, right? I've established the ICP. I've looked at the product differentiation. I start to have our unique selling propositions. And then I'll start to look into the competitive research, right? And looking what else is out there in the market. And I've just seen companies that are competitors that just haven't put a bunch of time and effort into marketing, right? Would you consider that an indicator of future success? And if so, how? And if not, why?
Yeah, on the one hand, it's very powerful when a company reaches product market fit without having to buy business, right? Buy attention, etc. It's just a great product, a great solution for a problem that customers really are experiencing. They are very problem aware and they find you and they love what you do. Of course, that's also a reason why a market or a category might be under penetrated by players who could maybe sell even more if they make more of those customers problem aware, right? And drive great sort of outbound demand generation. They're not just doing demand capture, but you start doing demand generation. And I think that's where a lot of customers who are either part of a diligence process or they're reviewing what to do with their go-to market, where they are being met by someone like us, right? Because they basically say, we think there's more to gain here. There's a lot of potential here. We haven't realized that. And what if we could do some more marketing or sales or other go-to-market levers to capture that upside?
Absolutely. I think, along that vein, right? I think there are coming probably rarer, but still exists, right? Where if you look at some of the market, you see that either the incumbents just haven't staked a claim for themselves yet effectively in the market, or even that there's, you can look on a tool like Ahrefs or SEMrush and see that there's just a lot of keywords, right, that relate, which basically means that the market is searching for a solution on your topic or your industry, right, that don't have high competition, right, that do have high relevance and high traffic, right. That is a fantastic tactical way to see that, hey, there is demand here that isn't being filled, right, and my company can go in and fill that relatively easily, right, with a straightforward path.
The problem, of course, that when you're in a mature market, the kind of putting maybe a bow on the whole the audit part of the market situation. If you're in a mature market, it also means that the leaders of that category might be suffering from some incumbency challenges, right? The incumbent, of course, has a leader's advantage, right? They may have the credibility, they have the existing clients they can learn from, and they can make their products better because of that, etc. But they also suffer from what's called the innovator's dilemma, right? Previous success may prevent you from being incented to constantly innovate and to change the rules of the game. And that's why there's an option to disrupt the market like that, right? If you come in and you sort of say, hey, what worked yesterday might not be what's needed tomorrow. And I think that's where this audit process, of course, it's such a powerful combination to look both at the market situation and think of incumbents who are leaders in a category both as a challenge, but also as a real opportunity, because they might not be as focused on the thing you could go do to drive growth.
Yeah, absolutely. And then, taking it all the way back to the ICP, right? Understanding what the personas and the ICP and their needs are, right? And understanding the market and what needs it's filling, right? Allows you to see, is there a gap where I can basically outperform my competition from a product perspective, or even underperform, right? And just be cheaper and more approachable, right? You don't need to have the enterprise product to stake a claim in the market. Let's move on to, looking at this through the lens of the different go-to-market motions that a company could have, because that does start to change the way that you look at things slightly, right? The three that we typically like to use are sales-led growth, marketing-led growth, and product-led growth. And of course, there's hybrids between the three, but let's just stick with those three for now. What do you typically look for? Let's start with sales-led growth. In a sales-led growth type of company, to show either that they have initial success or that there's an opportunity for investment and growth.
This is a really important shaking the tree part of the audit process. You encounter a lot of early stage companies that have over-invested in a relatively expensive go-to-market, right? If you have been in growth mode, and especially if you've raised capital before, it's very easy to say, hey, I can just outsell or outmarket my peers and be successful long-term. The problem, of course, is that in a maturing market, the cost of doing that will go up. Customer acquisition costs will go up in a market where there's more people bidding on the same Google ads, or there's more people vying for the same organic search positions, etc. So when you walk into a situation where there's an actual sales organization that needs to get paid salary, that will take commission or another form of variable pay, in addition maybe to marketing being the only source of growth, because the salespeople expect leads to be handed down to them instead of generating their own funnel. Before you know it, those costs are pretty high. So the first part of the audit is your ACV, your average or annual contract value, or even better, your ARPU, your annual or average revenue per user or per unit, if you don't price per user. Is that able to sustain not only the CAC, the customer acquisition cost, but also the cost to service these customers long term? And we have a couple of rules of thumb, right? But if I'm just making these numbers up now, but they're in this kind of range. But if you're paying your users, if your users pay you, your customers pay you a couple $100 per month, maybe only $20, $30 per month, it's very hard for you to ever make money if you need to do actual selling to get those clients, right? If you have one sales conversation, and usually it's more than one, usually there's an SDR call, and then maybe there's another initial sales assessment, sales discovery call, and another call to do some form of a demo or proposal. Before you know it, you're 2-3 calls in, and this process has already cost you a couple $1,000. So if your customers only pay you a couple $1,000 per year, you're never going to make that money back, right? The unit economics, as we like to say, are just not going to be able to scale. So that's why I think, especially when you see an organization being sales-led, but that's their main go-to-market motion, that you have to be it's a very quick audit part. You have to extremely focused on is the size of the typical client and how that size can grow over time. Is it going to be able to support that go-to-market strategy?
Yeah, that's a fantastic point. And honestly, even just doing that alone catches a lot of strategic misses, I think, from what I've seen. To your point, right? You can look at things like, your LTV, lifetime value to CAC, customer acquisition cost ratio, right? Or even just to make it simpler, you can look at your payback period for customers, right? And basically take a look at, once I land this customer, how long is it going to take for them to pay back the cost that I put in to get them? And give yourself an idea, right? If it's going to take longer than, say, a year, right? Your customer success and your product must be really good to be able to make sure that that's going to work, right? And if not, then you have to start asking yourself questions. I've also seen it where executives and founders can almost get trapped in a bad go-to-market because the costs are too high, right? They're spending too much to acquire their customers, but they are acquiring customers. And they'll see the numbers start to go up, and they'll see the revenue start to go up, but they're seeing their costs expand, right? Almost increasingly. And they say, okay, I just have to get more revenue. I have to get more revenue. I'm going to pour more money onto the revenue fire, right? And it can be a really vicious cycle and very hard to break. So it's really important, as you're saying, right, to take a look at that early and understand, right, what go-to-market does my customer acquisition cost and cost of service actually support? And am I using that right now, or do I need to have a change in strategy?
Yeah, and this audit is usually a couple of questions, right? What's the typical size of a client? Has that been growing over time?
Mm-hmm.
Are there easy ways to make that cost go, the ARPU or the ACV go up, right? Are you discounting a lot? And can we stop doing that? Have you not raised your price in the last couple of years? And should we, right? Are you paying your sales team maybe commissions that are not necessarily reasonable, right? Can we cut those a little bit? And so there's all these ways to immediately address if you find some quick sort of challenges there. And I think, so that's an important part of the audit that also is not that big of a lift.
Once you kind of identify that sales-led growth is, say, the right go-to-market strategy, I feel like I've seen a couple indicators that show that something like marketing could benefit and grease the wheels, I guess, of that new revenue engine. And some of those things that I've seen are say, like a long sales cycles that seem longer than what the average contract value should support. Or say inefficient funnel, right? There's just a lot of drop off from in ideal customer profile prospects from start, the top of the funnel down to the bottom, or even just the sales team complaining that leads are just too cold, right? When they come into the sales conversation and having to kind of nurture them manually as they go down. Is there anything else that you've kind of seen in terms of a more like once we've established that sales-led growth is the way, that would show you need to dig in with marketing?
Yeah, I think what's really important, marketing and sales funnel are so integrated in a modern SaaS company. There's no way you can have the marketing funnel really stop at any point, or the sales funnel almost cannot start early enough. Mm-hmm. What do I mean by that? If the marketing lead gets handed over to sales and it becomes a sales qualified lead and then turns into an opportunity, etc. At all those stages, marketing should still, first of all, help with nurturing and having great sales support and materials, sales enablement, all those things. Which you should also still learn from every conversion that doesn't convert, or every conversion that requires more one-off pieces of content, or an answer to a certain objection, right? All that is constantly part of marketing. And then the other way, I mean, sales can start so much earlier than when they get handed a lead. They can do a lot of their own sales development by canvassing their network, understanding what kind of audiences are out there doing LinkedIn research. And all that is, of course, really also part of the marketing funnel. So I think my first inclination also in an audit is to kind of see how much the funnels are overlapping. And you want there to be overlap. You want these teams to work really closely together. Ideally, both teams are incented partly on each other's goals, right? So there's a reason for sales to care and marketing to care that things convert deeper in the funnel. So the audit should really look at that, whether these teams are potentially too much siloed, and because that's completely unacceptable. And then there's just are they doing the belt and suspender work, right? Is sales filling in everything in the CRM system? Because that's not something they do to get their bonus or their commission. That's part of the job. That's why they get their salary. Is marketing caring enough about leads that they hand over to ask what happened with them? And if they didn't convert, why, right? And how they can constantly improve that and make sure that the sales team has the best materials possible to support conversions, etc. So I think those are areas of the audit, maybe that don't jump right away from the spreadsheet, but that are really important to dig into.
Yeah, sales and marketing alignment, particularly in sales-led growth, is critical. I do think that I've also worked with this, maybe this is an easier audit, but with companies that have found success and maybe even product market fit with just minimal marketing investment in something like a sales-led growth strategy, and just because they have good product fit, right? And they have a sales team that can go out and get leads. But usually in those scenarios, I like to look at if it's something where the company's brand isn't that well known in the market, right? Or the sales team is having to kind of scramble and create custom assets every time that they're selling, right? That shows me that there is a solid need for marketing, right? And if marketing can kind of support the brand and support the sales cycle, right, it can really start to scale their sales efforts. It basically can facilitate faster sales cycles, higher close rates, right, and just higher success, just making the most out of the sales team that they currently have.
Yeah, and it goes back to the definition of sales and marketing is not as sharply kind of divided, right? So
right.
When you have a company that's growing without a large or maybe a marketing team at all, usually what it means is they're doing what we call demand generation and less demand capture. Demand generation is still, of course, for a large part marketing related, right? The salesperson who's building their own pipeline is just really, really good at the early stage of the pipeline. They know where to find prospects. They know how to find maybe a new list. They understand how to go after, how to do the outreach. Guess what they use for that? Email, the phone, marketing tools, right? They track things. They have maybe a subscription in LinkedIn that makes it easy for them to manage leads, right? The leads in their pipeline.
They're good with
Those
that.
are, of course, all, you can argue they're just as much sales as marketing tactics. They're just being done by a group of people who are maybe called sales. But you also need good content, right? There's no way demand generation by a sales organization works without having a couple of good lead magnets, without having good call scripts, without... What does that really mean? You have a good value prop. You have something to say. You probably have some customer testimonials. So all those things are not necessarily sales or marketing. They're just proving that there's always a combination of those things. And when you find a sales-led go-to-market that's working, it usually means they're in a category where you need to do demand generation. And you have the team in place who's able to do that, whatever they're calling themselves. And then when you have an organization where the sales team is much more passive, and when it comes to funnel creation, it's usually because you're in a very heavily market, in a market that's very heavily depending, whether right or wrong, on demand capture. Right, so you typically see both sales and marketing have basically agreed that the best way to grow is to make sure that you are found by everybody who's already looking for a solution. Right, they're typing something into Google, so SEO, SEM, being at a certain event where people maybe visit your booth. Right, all those things are forms of demand capture. And those are typically the environments where a sales organization would say, "Hey, we don't have enough leads. The marketing is not doing their job because we think there's more demand out there that we're not capturing," right? That's typically the... And of course, when you're in early stage companies, those are not healthy discussions if they go like the way I just described. So what you really want is that between demand capture and demand generation, you have the right balance, and both marketing and sales personnel is doing their parts in both, because both need both disciplines.
That's a really good point. I think two things there. One is that particularly on the demand gen or the demand capture side of things, right? A company that is depending on that, almost needs to be in that competitive market, right, for that to work, right? There needs to be existing demand to capture, right? But then also, I really liked your point that whether or not they have a marketing team, if the salesperson is going out and generating demand, they're doing marketing. They're just called a salesperson, right? So whether or not you have a marketing team, you're likely still investing in marketing, just through a different set of people.
Yeah, and it all depends how you define those two terms, marketing and sales. But sales is usually some form of, there has to be an actual opportunity.
Mm-hmm.
Someone has to have said, I need a certain solution and I'm in the market and there's a time connected to my needs. And then, of course, the salesperson's job is to turn that into you being picked as the one that they buy from.
Yep.
And everything before that is usually called some form of marketing or business development.
What do you think about marketing-led growth? So this means that the average contract value probably comes down a little bit. The speed of sale increases, right? And the volume needs to increase, right, to get to your corporate goals. But what do you look for in those scenarios that show potential for growth?
Yeah, the essence of marketing-led, and sometimes also a little bit of customer success-led, is that you basically don't have the ACV, the typical value per customer, to support actual sales conversations. So you need to have a leveraged model. And marketing and customer success are your biggest levers when it comes to using people resources to influence deals at scale, a large volume of your pipeline. And one customer success resource person could build the full onboarding playbook and make sure that a lot of those onboarding processes actually happen. One marketer can run a campaign that generates multiple leads. Right? There's not a one-to-one connection with funnel contribution. It's much more one-to-many. Both customer success, when you think of upsell and cross-sell and referrals, etc., and marketing when it comes to more the net new funnel generation, right? New leads, new opportunities going into the pipeline. So when you have an earlier stage company, and there is a lot of market making to do, right? The customers are maybe not demand generation, as we like to say, and your ACV is relatively small, a lot of that will have to happen by the marketing function. They'll have, whether it's a sponsorship or being in a certain community where you think your target audience is showing up and to have conversations about their day-to-day work, and you're trying to drive awareness. Then your go-to-market, if dependent on demand generation, will require marketing to do that, because your ACV just doesn't support sending individual salespeople, for example, to an event like that to go meet with people one-on-one.
Yeah, you definitely can't go target at this ACV. You definitely can't go target each person individually, right? It can get prohibitively expensive fast. To our earlier conversation, I think more tactically, some of the things that I've looked for, especially in an audit, right, is just looking at the funnel and understanding, well, do they have visibility into that funnel, right? That's a key point. But also how, of that funnel, how much of that is actually organic people coming and finding you of their own volition versus you paying for ads, going to events, and going out and capturing that demand yourself. Also, just looking at the funnel conversion rates, right? Are people, again, on the inbound side, self-selecting down the funnel into a sale, or are they having to be kind of like dragged and hooked and crooked down? I've also looked at I've seen a lot of companies that have marketing in place, but maybe haven't put the time and effort that they need to into positioning and messaging, right? Where they just come in with they're a little generic. They talk about themselves a little bit too much, right? And they just aren't communicating the value that they should be to their ICP and to their niche, right? And so they come off a little bit general and just aren't effective. And then I think I see things like that in combination with, say, a high retention rate once people come in the door, or a high customer referral rate. That tells me that the product is resonating with the customer base, right? And they have fit, but just haven't really pushed hard enough on the marketing side, right? They haven't created the thought leadership, haven't created the right messaging and channels to really capture the demand that they need. But they do have the fit, right? The product, the hard part almost is done, right, from the product side. And now they just need to go communicate that to the market.
Yeah, that's also why when you look at marketing-led growth, it is often something that really is useful in earlier stage markets when the market still needs making, right? But when a market or a category matures and you have a lot of established players, marketing-led growth becomes also very expensive, and it becomes much harder to really grow, because it's just about redistribution of the pie, right? The market itself is not growing that fast anymore. And redistributing customers in an existing market is costly, right? Customers don't like to switch, so there's usually a high switching cost, which means you have to do a lot of convincing for a customer to switch. And then you're competing for the highest places in the auction when you think of paid clicks and sponsorships and all that. So as soon as categories enter the territory where Capterra and G2 Crowd, etc., win all the organic search positions because they have all the competitors, they have these marketplaces and all these review websites, it becomes more and more questionable, and especially in an audit, you can look for this, questionable if a typical marketing approach to your go-to-market had demand generation, but even demand capture, when you think of capturing the demand that is going through some of these online marketplaces, becomes very expensive, right? And often hard to do.
And the more competitive the market gets, the more expensive it will get, right? And so you've talked about this in previous podcasts and blogs, but it can, as you start to reach that point, it can be really important for you as a company to start looking at, do I take my product and push a differentiation strategy, right? Where I, again, outperform the competition in a certain area, right? Which allows my contract size and my ACV to go up, which supports a higher go-to-market strategy or more in-depth go-to-market strategy. Or do I go and disrupt, right? And find a gap below the current market that isn't being serviced, right? That allows my service to be much cheaper, but then also allows me to have a high volume play that's much more like a product-led growth. But again, it's a tough decision to make, right? Because the timing of that is critical. And I'm sure in that scenario, right, your marketing-led growth is technically working. You're driving numbers, but your costs are starting to increase. So you really have to have a lot of foresight and be looking at these metrics a lot if you're going to make that decision effectively.
So that was kind of the second part of the audit, right? Figuring out if your go-to-market is compatible with your value proposition, the price point that you're selling at, and basically the unit economics of that go-to-market.
Which is a big conversation for the executive team, but it's critical, right? Putting that decision off doesn't help anyone in the long run. Let's talk through product-led growth really quick. Is there anything else that you would look at? Again, basically what this means is that your ACV is now down even further, right? To a point where the sale is really low friction and somebody can basically self-select their way into purchasing the product and onboard themselves, right? And this can all be done without human intervention, ideally. What are some of the things that you look at in a PLG company that show that it's right for growth?
Both product-led growth and sales-led growth are things that become increasingly important in a mature category, partly because what we just talked about, that marketing-led growth becomes harder to sustain and too expensive. The problem, of course, with product-led growth is that there's only room for a couple of winners in that sort of go-to-market model, because it's usually the one or two providers of the best user experience that are most connected to how individuals discover new solutions without being sold something or being marketed to. It's very unlikely that there are many players in one category that are going to win that part of the it's called the go-to-market race, right? So when I'm auditing a company that's banking on a product-led growth strategy, kind of want them to be in the number 2-3 spot or something like that in that kind of product-led growth ranking, right? If the number 7 and they were just able to create a great product-led growth motion, like mechanically, they have the content, the product is able to do it, they have a couple of clients who've enrolled through that doesn't mean they're going to win, right? Because this is a little bit a numbers game, there's flywheel effect, right? So unless you are able to show that in that product-led growth motion, you can be one of the top dogs, it's going to be hard to really invest in a company that hasn't proven that.
That's a great point, actually, and that I feel like a lot of people don't fully appreciate when they're building a product-led growth strategy is that, and tell me what you think about this, but is that just because the customer acquisition cost is low does not mean that marketing investment can also be low, right? It's just that the volume is so high that it creates a low customer acquisition cost. basically, to put it more in layman's terms, you still have to spend a lot of money on marketing, right? And what you're saying is either the company needs to already be a leader, right, in the category, right? They already have brand awareness, they already have an established market, an audience, right? And they can leverage that basically to create a product-led strategy, or they have to invest a significant amount of time and money to create the thought leadership, the channels, the ad spend, right, to build that audience quickly to be able to generate that volume. You almost have to know that you're going to be in the red for marketing for a significant portion of time, basically paying to grow through a product-led growth strategy. It's not, I wouldn't say that it's a strategy that you can kind of nickel and dime to start, right, and be successful at. But I want to get your thoughts on that as well.
Yeah, it goes to another problem, right? That when a go-to-market is hard, and hard usually is similar to expensive,
Mm-hmm.
then things like product-led growth just sound so sexy, right? If we can just do that, it will be cheap, it will be easy, right? And the other version of this is partner channel marketing, figuring out how to get a leveraged model through a partner channel that will do the selling and the marketing and maybe the servicing for you. And now we don't have to invest all this money in creating the market and getting the leads and all that. The problem with both product-led growth and partner-led growth is that they require a significant amount of success up front and usually investment. Product-led growth, when you do an audit and people are thinking that is the right model, it's usually either because the product is just a really good fit for that and the way people buy and the type of solution they're looking for and how they encounter pain, or it's because you're going after small clients, SMBs, small medium business, and this is just the only way to make the economics work. If that's the reason to think you need product-led growth, you got to really, really be careful. Because getting, and I, of course, ran global marketing for small and medium business at Microsoft, and I did many startups after that were kind of going after that market. Small and medium business only starts to work if you get to like 100,000 clients. Right? They don't all have to pay, but you need a lot of users, a lot of clients for those flywheel effects to start working. And getting to 100,000 clients usually means you have to invest a lot in market making.
Mm-hmm.
Not everybody needs a Super Bowl ad, but think of it like a little bit like that, right? You need to have you have to have deep pockets to get your initial go-to-market going. And after that, those unit economics can become fantastically profitable, but they will not be for a while if you have to start still there. And then, since I brought it up, a partner-led growth, a little bit similar. Not necessarily a Super Bowl ad analogy, but to become to have an effective, well-working partner channel, you need partners who also want to partner with you. and if you say, if you declare yourself partner friendly and you're going to recruit all these partners and you want them to sell, you want them to care about you. You want them to sell your solution, not only when their customers ask for it, but because they're trying to sell it. That they have to care about you. So you have to be either completing their solution, they will not be able to service their clients without your solution, or you have to pay them a ton of margin, or you have to allow them to do something easier, better, cheaper, faster than they could without you, right? So any of those three things is hard, right? And especially the middle, the second one, the margin costs a lot of money. So yeah, always product-led growth sounds extremely sexy and cool, same partner models, but they are not easy to do, and they're very expensive often to get started.
Yeah, and to your point on the partner led growth, right? At that point, you're basically making your partner. You almost need to have a partner ICP, right? You need to be solving, unless you're going to, pay an exorbitant amount to have them care, right? You're going to need to be solving their problems. It becomes almost a little bit less about the end customer and more about the partner.
Yeah, now you have to market to them. You have to figure out if you have a sales-led growth model, which means you have to hire a whole bunch of partner account managers, build a partner recruiting team, or it's more of a marketing-led growth, which means you have fantastic ICP, great value prop, and you know how to find those partners through content, through marketing. It's all the same, basically, as when you would have to go find new end customers.
Yeah, and then on top of the customer support that you would have to have, you need to have partner support where you're enabling the partner to sell, right? Giving them the right materials, giving them the right support. So it's not without its cost, but can be effective. Let's touch on the three levers. I think we've covered a lot of ground here, but let's touch on the three levers of growth really quick and see if there's anything that we missed. So, the three levers of growth that we like to think of when we're thinking about B2B SaaS growth are: how do you win new revenue, right, through marketing and sales? How do you retain it through customer success, right, engagement? And then how do you monetize it via, land and expand strategies, back to engagement, right? Maybe it's price increases, etc. How do you look at companies when you're going through diligence or an audit from this lens and understand potential?
Well, and the reason you did it in that sequence is because when you're coming in with Columbia, of course, often there's a marketing need specifically, but when I do diligence, when I'm looking from an audit lens, I want to work my way back from the
bottom
funnel. Do you actually get more over time from your existing customers, right? The monetization point. Because unless you're able to grow your existing clients, which basically is a proof point that you're adding value, that you're able to build a sustainable SaaS business, because SaaS is a combination of two S's, right? Software and subscription. And software is, of course, the fact that you're selling something that doesn't cost you anything to produce, right? After you've written the software once, you don't need to have any cost of goods after that. But the other S is just as important. It means that you want people to pay you forever, or for a long time.
Mm-hmm.
And for that, of course, you need to add value again forever, tomorrow, right? And so are you able to do that? And monetization of your existing client is the best way to see if that's working, right? Are you able to make sure your customers are getting so much value that they stay, of course, but you're also seeing growth. You're seeing them add more users, buy more capability, tell others about it, right? Help you get referrals from them. So that's the monetization part, and growing maybe your revenue because you can do a price increase without your customers running out the back door, right?
Mm-hmm.
That's all about monetization. So I look there first, because unless you're able to monetize at least a certain amount of your customers, you're gonna probably have a hard time retaining all of them, right? And that's the second part to look at. Things like churn, right? Are you able to retain clients? There's kind of two churn, I guess, windows. And one is it needs a little bit of a different approach than the other. The first is what happens in the first couple of months after you sign up a new user or a new client. Because this is more of a function of, are you able to convert the excitement and you're selling them on your value prop to them actually experiencing the value prop. And the magic of product-led growth, for example, is that happens really fast, right? It happens sometimes in seconds or minutes. But if you're not doing product-led growth, if it's more marketing or sales-led growth, you still probably need a couple of days or weeks or sometimes months for a customer to actually experience the value that they were sold, right? So to do good retention, that is a critical part of the journey. But high churn numbers there don't necessarily have to be bad. They are usually a reason to look a little deeper. But if you have a lot of churn in those first kind of onboarding weeks or days of a new client, it could also mean that you're just not keeping clients that are going to be hard to service long term anyway, right? Mm-hmm. That will churn at some point, or maybe be a huge burden and have a high cost to service for your customer success team. So churn in that first period is one number. And then the other is churn after customers have experienced value, right? When they've at least, you've proven that the value that you sold them was there, right? And they like it, and they went through that sort of onboarding period to experience that total value. Any churn after that is basically bad, right? If it's not a function of the market you're in, if you're in a small business market, maybe there's a certain amount of customers who just go out of business over time. It's nothing to do with your software. But once you've accounted for that, any other churn there is a reason to sort of ask yourself, is my value, just like I'm asking my customers to keep paying me, do I keep providing the same level of value, right? Is my product maturing? Is it getting better over time? Or is it staying at least on par with what the competition has to offer? And then most importantly, am I doing what these customers expect on a consistent basis, right? If there's service level issues, right? If the product is not always available, right? Or if there's interaction needed with your team and that interaction is not great, those could all be reasons for customers to churn. So that second window, after the value creation, it's an extremely critical part of the audit. And you absolutely want to see two churn numbers. You want to see both revenue churn, because that's a good indicator, of course, of the business, the state of your SaaS business economics, but then also logo churn. You want to really look at those separately. You can hide a lot of revenue churn by doing good account expansion, right? Often then when you have that compounded number, you see things like negative churn. And that's all very healthy because it's good. That's how you look at the finances of your company.
Mhm.
But it's also good to look at logo churn to kind of see, hey, how am I doing keeping individual customers that are maybe were happy at some point and that I want to, of course, keep happy. And then the last part is, once you've done that, now it's time to, of course, spend a lot of money to get more customers, right? But you don't want to do that unless you are able to keep them and to grow them. So customer acquisition and demand generation or investing more in demand capture is usually really the third thing I look for. Also in the audit, it's not where I start, it's where I finish.
Yeah, I think that's a great way to look at it, right? On the monetization side of things, right, you're basically asking, is my product sticky enough to warrant people to pay me, right? Not just pay me with their time, but pay me. And is it sticky enough for them to survive and want to keep coming back after a price increase? But basically the question that's asking there is, are they continually getting enough additional value from the product to warrant both of those things, right? Paying for it and even paying more for it. On the retention side, right, does my product solve my customers' real problems and do they actually need it or use it? And then to your point on that early churn, right? Am I bringing the right customers in the door, right? Even if the marketing and the sales pitch work, right? Does that actually match the product of what the product delivers for the ICP that you're targeting? And then, of course, on the marketing and sales side, right? Do I have an efficient demand generation and capture machine, right? That is connected to the product's value, right? And successfully can nurture a company or a prospect all the way down to close in a repeatable, scalable, and positive ROI way. Those are kind of the general avenues to look. And with that, we'll wrap. Thank you so much for your time, Stein.
Thanks, Ryan.
Thank you to Adriana Valerio for producing this episode and the Kalungi team for helping us make this whole thing work. And of course, you for choosing to spend your time with us. As a reminder, all the links we mentioned in this episode can be found in the show notes. And if you want to submit or vote on a question you'd like us to answer, you can do that at kalungi.com/podcast. Every time we record, we take one of the top 3 topics and jam on it. Thanks again.